How are we doing, everybody? So, as you can see, the title of today's video is about how to apply fundamentals to technicals. Now, when I started back in 2018, I started during uni, I was always told by a lot of people who I could, were my, in quotations, mentors, that fundamentals aren't that important. Now, as you may have seen, literally since COVID, it has been super important. It has been important for decades and decades and decades. But from what I've noticed, and that sort of that change and shift in sort of mindset from a lot of people, is prior to sort of COVID, a lot of traders were not interested in fundamentals, mainly because of how complicated it is. Now, since COVID, and that's a very nice shift, and I quite like it, a lot more people are interested, which is good. And today's video is going to be about how to apply it. This is my personal way of what a rough framework. If you want to see a bit more detail, we have made a full video on it on our website for our members, how to read fundamental data alongside sort of other stuff here. This is just the expert section. We of course have intermediate and beginner. But yeah, this is just a sort of very rough guide on how I would use fundamentals and technicals together, because both work hand in hand. Technicals is a way of entry. To me, it's not a way of finding a direction. It's just because, remember, technicals is past data, right? You're working on past old news, if you will. Fundamentals gives you that guidance of where a currency pair or an economy should be in the future. Then use technicals as a way to time an entry. So if it comes to like a demand zone or a supply zone or any other technicals that you want to use, you can do that. Every technicals works to their own degree, of course. So how do we apply fundamentals to technicals? So this is a way I would roughly do it. Firstly, number one, let me just get out my text tool. What I would do is understand the basics. And now, if you want to understand the basics, we have made a big playlist on our YouTube on the real basic stuff. So the real basic stuff is stuff like this, where if I just do this, which would be GDP, it would be inflation, and it would be, of course, interest rates. I've also added another video on there. I'm not sure if it's in the playlist or not. I can't remember off the top of my head. But monetary policy. And those are the sort of the main things we would mainly focus on, because FX, right, they have three pillars. They have three drivers at most times. The three drivers of FX, or the three pillars of FX, I learned this, I think it's around end of 2020, 2021. Right, yeah, roughly 2021. Three pillars of FX is as follows. Rates, just trying to remember now, I've literally got a brain blank there. Rates, commodities, and equities. So those are the pillars. So currencies mainly work on either rates. So rates would be stuff like the bond market. So it would be like the gilts, which is the UK bond market, or the bunds, the German, or as you may know, treasuries, which is of course the US, and so on and so forth. Just in general, that's what would move on. Commodities, so as you may know, stuff like oil prices or gold or gas prices, lumber, currencies can move on that as well. If that economy exports that main commodity, like we know oil is very heavily on like the Middle East, although a lot of Middle East currencies are what's known as pegged currencies. Canadian or Canada, if oil prices move, that could move CAD. And of course, equities as a function of risk on, risk off. So I'll put RORO as it's commonly referred to as, risk on or risk off. So those are the sort of the main three things we must be thinking about when trying to apply technicals to fundamentals, right? So let's start off with what we should be roughly focused on here. So let me just do this. Is it working? I think it is. Now, understand the basics. So what do I mean by understand the basics? I don't mean by, for example, what is GDP and then that's it, or inflation is the change in prices of goods. okay, great. But you need to look into a bit more depth into what is inflation, what creates inflation, how does deflation happen, etc. And that, of course, ties on to this monetary policy video, which should be on our YouTube. Now that we have sort of the basics, and I assume you would have watched the little playlist we have on what are those basic stuff. How do we actually apply fundamentals to technicals? Now, number one, we must always. So let me just move this up here and then create a new little text box. I'm recording this on OBS, so if the quality is good, please let me know. Normally, I record on Zoom. However, I have noticed Zoom is a little bit, glitchy for a few people. So I'm trying to record on OBS. So if it is better, please let me know. And I am a noob with OBS, so if anything happens, please forgive me. But this is the main thing we have to think about. First, number one, what is the theme of the market? What do I mean by what is the theme? Basically, what is everyone yapping about? Everyone is chatting. So I'm recording this in May 2025. So we know everybody is yapping about tariffs. That is the theme of the market. Literally, the theme is, what is everyone talking about? So the theme at the moment is tariffs. So how do we apply the knowledge of tariffs on currencies? So number one, you have to be thinking about who's affected the most versus who's affected the least. That's what we need to be thinking about in this market. Back in 2022, it was all about inflation and interest rates. Obviously, we're in a slightly different environment where the theme of the market is tariffs. Once that begins to become a little bit boring, that's when you start to think about data and rates and commodities and equities. But for now, in this market environment, in sort of May 25, we have to be thinking about tariffs. So how do we do that to our advantage? So what you need to think about, like I said, who's affected the most versus who's affected the least. With that, you have to do a little bit more research. You can go on to the likes of, for example, if I come up here, go to Bloomberg. Bloomberg is a good website to use. You could also use ING, which is another good website. We pretty much use that a lot. Let me just move that camera a little bit. There we go. And there we are. So that's what we need to be thinking about here is tariffs. So you can go onto here and sort of, they'll be talking about tariffs on sort of ING. Bloomberg is, of course, another good website. Another good free website for you to use would be Reuters. I'm sure you've heard of Reuters before. But basically, all you need to be watching is, what is Trump saying in this environment? So what is Trump saying? Meaning, are there any deals happening? If there is deals happening, then people will begin to become a lot more optimistic on those who are affected the most. Because Trump's tariffs is really bad for their growth, right? Bad for companies' growth. So, because at the end of the day, it's not really the country that pays the tariffs, it's the companies, and then therefore that passes on to like us as the consumer. So the companies will be affected the most, which will then bleed through onto growth and GDP and inflation. You can see how it all ties together. So what is Trump saying? Are there any deals happening? If there are deals happening, those who are affected the most will strengthen the most. That's why you've seen periods of euro strength. You've seen periods of AUD in particular, New Zealand, because they are affected as a proxy to China. So that is what we need to be thinking about at this given point. So who's affected most versus who's affected the least? If you see more deals happening, you want to be buying those currencies who are affected the most versus who's affected the least. Does that make sense? If suddenly now Trump, goes back on his word and says, actually, there is no deal happening with China, or it seems to be following through or falling through, there's a bit of tension. Then we go back to the period of, you want to be selling now those who are affected the most versus those who are affected least. Those who are affected least would be the likes of like the pound, because there's been deals happening there, and also when there weren't a deal, the UK is not really a goods country anyway. It's more services. So, and that period when Trump's tariffs all came through, the pound strengthened against a lot of people. Like we strengthened against the AED a lot. We strengthened against New Zealand a lot. Obviously, the euro, and of course the dollar, because the US was seeing a lot of stress. So in this environment, we want to be thinking about this. However, in a general market environment, so if I just move this out here, so this is kind of like a live example of what you'd need to be focusing on for May. But once tariffs all come to pass, and markets then go back into what is the next thing happening, this is what we need to be thinking about. So what you want to be thinking about is, what is the data doing? Meaning, or how you do that is, you could use Forex Factory. I've always used Forex Factory since starting. The reason I like it is because it's very clean, very simple, and I'm a simple person. So Forex Factory, really, really good. It gives you the basic data you need. That's all I use it for, as a calendar, etc. What you could also use is a website called Trading Economics. A little bit more complicated. However, it has all of the data we need. You don't need no special terminal. You don't need no, pay for services. All you need is, what is the data that comes out? Every bank, every trader accesses the exact same data that we will do. It's up to us to interpret that and suggest a trade idea. So what we need to do is, what is the data doing? So if we go back to the start and say, what is the theme? Because obviously a theme always drives markets, remember. So let's say the theme is, who's cutting the most? So that's the theme of the market. Who's cutting the most? Then we need to think about, what is the data doing? Because the data will suggest who needs to cut the most. Obviously, if you've been trading through 2022, in that period, you would be thinking who's hiking the most or raising rates the most. Then you suggest any data that applies to that theme. Because what you need to remember is, all the data you see on Forex Factory or Trading Economics or any other news websites you want to, or calendar website, sorry, that you need to use or that you are using, seems complicated because there's so much bits of data. But really, if you crunch it down to what's actually necessary, it's not a lot. It's really not a lot of data. So in this environment, who's cutting the most? So what data suggests, spelling's off, suggests cutting? That's what we need to be thinking about here. So for example, interest rates, inflation, growth data, and employment, I guess, because they all kind of work hand in hand. Employment data. I'm just trying to think if there's anything else. That's about right. Probably wages as well, to some degree. But inflation and growth data / employment is the most important bits of data here. So what do we think about here? We need to create a step-by-step process where, if I zoom out, and I'm just trying to get onto blank bits of things here. Remember, understand the basics. This video is not really for those who are brand new to fundamentals, mainly because of, you need to know what the actual data means before you can interpret it, obviously. So you need to know what GDP is, you need to know what inflation is, you need to know what interest rates are, and you need to know what monetary policy is. That's the absolute bare minimum. After that, it becomes a lot simpler once you understand the basics. So move that up here and then move that up here. And in fact, if I just reduce this to, let's say, 20, that would be a bit easier for us. Perfect. So there we go. We're getting somewhere. And wages. So those are the main 3 bits of data we need to be thinking about. What you then do is stuff like this. So for example, I would go through the calendar. So growth data from the UK today, GDP, very, very good. Is not expected to be as That's great. I mean, it was expected to rise anyway on a quarter-on-quarter, but we came in at 0.7. That's very good. And what that kind of suggests is maybe the BOE doesn't need to cut by more. And then if you go onto the calendar, I don't just remember what currency I'm on, Euro GBP. We go to like the likes of like pound. We can see this morning it was stronger against like the AUD as well. We were stronger. So that suggests that maybe if we look at gilts, because remember the pillars to FX, gilts, oh, wrong one, GB02Y, yields did fall to some degree, actually. Quite surprising, though. I wouldn't have expected that to fall a little bit. Although, let me see, this morning, 7 o'clock. We did come slightly higher, but I think it's largely following US's, if I remember. Yeah, it's following kind of the US's yields. But generally, what you'd need to be thinking is that would suggest that the central bank will probably not be able to cut by as much. That's just one set of the data, remember, because we need to be thinking about overall. So growth in the UK, pretty decent. We then need to be thinking about inflation now. So what you can then do is go on to trade in economics when the next inflation data comes out, which I believe is next week. Remember off the top of my head. CAD inflation. Yeah, so next week we of course have CPI. So if growth has been pretty good, CPI is staying sticky. In that environment, unemployment, as I looked at last week's, or not last week's, this Tuesday's growth data was okay, or employment data was pretty good. In that environment, you wouldn't want to be selling the pound. Obviously, I am recording this in May, remember, so it's a little bit different where we need to mainly focus on tariffs because that's the theme. What I'm basing it off is if there were no tariffs, remember. So if there were no tariffs, that's what we need to be thinking about is growth data is good, inflation staying sticky. If wages were sticky as well, which they did come out pretty sticky on Tuesday as well, you would be long the pound versus the same structure. The same structure on the euro, the same structure on the Canadian dollar, the US dollar, the Australian dollar, the New Zealand dollar, the yen, the Swissy, etc., and any other emerging market currencies you like to trade. That's literally there. Like it's not, it sounds simple, obviously, but like it's only simple once you understand the basic stuff. The basic stuff of GDP, the basic stuff of inflation, the basic stuff of interest rates, and the basic stuff of monetary policy. Because remember, all of this data here applies to monetary policy. So everything you do is you think data comes out at X ... This means the central bank would do Y. And that was on, and of course, if that suggests that they should cut by less, you obviously go long the currency. If it suggests that they will need to cut by more, then you go short the currency. And that's what I'm saying is you need to watch the monetary policy video because that will give you on our channel, of course, because that will give you a good guidance on what is hawkish, what is dovish, what does dovish mean for the currency, what does dovish hawkish mean for the currency. But generally, a hiking rate is pretty good for a currency because it offers high yield for investors. Traders will see that. They'll sort of buy into the economy because they get better returns, etc. You might see videos on people where they say higher rates or higher interest rates is bad for the economy. Technically, yes, because it means there could be less loans, less growth, but that's a really long period. And what we need to be focusing on 1 to 3 month horizon, possibly a 3 to 6 month horizon. Obviously, it really kind of, I'd like to focus slightly shorter term because 6 months from now could be largely different to what we are now, right? So I focus on a 1 to 3 month horizon. And then if things begin to change, that's when you begin to change your bias. So if we see, for example, this would then, let's say this then all suggests the currency should go up. Cool, that's fine. But then let's say in the sort of month or 2 month now, we start to see data slow. So stuff like this, where the data was doing this, creeping up, creeping up. Obviously, it's never going to be a really nice move higher anyway. It's always going to be chop, 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 chop. But that's why you get the totality of all of the data rather than basing it off one bit of data. Because that's what a lot of people will try and do, right? They'll look at NFP, for example, and say, oh, NFP's weaker. Let me sell the dollar. But then what they're thinking about, or what they're forgetting, sorry, is the totality. The totality might have been very, very good. So this might have been a tiny bit of a blip in the data, or certain sectors might have dragged down NFP. There might have been, for example, strikes. Strikes can bring down NFP, or natural disasters like tornadoes, or not tornadoes. What's that word I'm looking for? Hurricanes. Hurricanes in Florida, obviously, they're a very hurricane prone state in the US. When hurricanes go through Florida, that brings NFP down, or it can bring NFP down. If you know it's only because of weather, you look through the data and think, okay, the data is still very good. Let me still go along the currency. Does that make sense? So you have to understand the basics first. Like, I can't stress that enough. Like, when I was starting, it was really difficult because there weren't that many people who would teach fundamentals. So it was literally, for me, a trial and error, trying to go onto Bloomberg, watch Bloomberg Live. It's free on their YouTube. Every day, I still do it to this day. I've got it on my other screen here. So, because they talk about stuff, and then you think, oh, that's quite interesting. Let me go out and research that. So that's what I did. And then, obviously, trial and error, trial and error, trial and error for many, many, many years. So the data has been doing this. Sorry, I always go off in tangents, but I try and explain it to the best of my ability. So the data's doing this. We then trend up. Once you start to see it plateau is when you now need to start shifting your view. And that's, remember, the totality of the data. If you see inflation do this and we plateau slightly, but growth is still doing this, employment's still pretty strong, wages as well, which can contribute to inflation, or which does, is still pretty strong, we know the likelihood of this going lower is unlikely. Because if employment is up and growth is up, then inflation should technically rise with it, because as people earn more, they tend to spend more. I know I would do that. I'm not sure about what everybody else would do, but I know if I earned more, I would, of course, spend more. I'm not going to sort of be, oh, I'm going to put it into this S&P and try and I will spend more. So that would, of course, if employment's up and growth is up, inflation will tend to rise with it. So if you see a little bit of weaker data, but we know employment and growth is still pretty strong, then that's when you think, okay, a little bit of blip of data, we see a bit of a pullback in the currency, but you use that as an opportunity to go long the currency. And all you do with technicals, which I'll get into in just not too distant future here, is you only look for buy or demand zones. For me, it's supply and demand, so I use demand zone if I'm buying, of course. Then I'll be thinking, okay, I want to go long the currency. I'm only looking for demand candles. I'm not looking to sell it. I don't care about supply zones because I'm not selling it. There's nothing telling me I need to sell it. Pull back, buy. Pull back, buy. If we pull back into my zone and it comes lower, I'm still buying it if the reason's still there. So, because you always have, like, you might see zones, as I'm sure you might have seen with your sort of technicals before, where you mark out a zone, it comes into your zone, you see a little bit of reaction, you enter along, you then get stopped out, fine, losses happen. But then it comes to a zone slightly lower, you lose the confidence in the trade because you think, oh, there's a break of structure, or whatever people want to call it nowadays. I call it break of structure. That's always what it's been known to as me. You see a break of structure, it rejects out of your demand zone or a demand zone. It goes up, but because you've seen the break of structure, you're looking to sell it. And then you get stopped out on the upside. But when in reality, it was just a higher time frame pullback to go back up again. So this is why fundamentals is important, because it gives you that direction on a higher time frame. So all you now need to do is then just apply the thesis and go with it. If you get it wrong, it's a learning curve. You're not always going to get it right. I don't always get it right, but I use the learning curve and think, why didn't I get it right? And what could I learn from that? Because now I may not need to sort of make that mistake in the future. So less yapping. let's get straight into technicals. So this is a real basic thing. I've made a very detailed video on our website for our members, but this is a real basic thing of what I need to do. Let's quickly summarize that. So firstly, with a cherry on top, understand the basics. So let's forget about the tariff stuff because that's generally, very short-term news, as it has literally since when Trump got inaugurated. I can't remember off the top of my head. It really became prevalent in March. So really 2 months is not a lot for a market sort of theme here so far, March, and of course, let's say a month and a half. So this is kind of shorter term news. That's what's known as tactical. I may make a video on that. It's known as tactical and long-term market views. Tactical tends to be shorter term. But let's say we're in a general market environment here, and what we need to be understanding is the basics. Nail down what is GDP, please. What are the components of GDP? What makes up GDP? Why does GDP change? Like you would do with technicals, where you're not just going to look at a trend and, oh, if we start to see a pullback, I'm going to buy. Or if we pull back into a fib zone, I'm going to buy. You need to dive a little bit deeper and get a good grasp of technicals. It's the same with fundamentals. Don't just get the basic stuff of what is GDP or what is inflation. Dive deeper. It will take a bit of work, but nobody in said trading is easy. What is interest rates? And of course, what is inflation? And then what is monetary policy? Once you have those three nailed down, then understand there are three pillars to FX: rates, commodities, and equities. Either one of those three in a normal market environment, removing tariffs and any other external factors like wars or whatever, are the main drivers of FX. It's either rates is a function of policy. If it's not rates, it's then commodities. So if oil prices are spiking, you might see Canadian dollar go high with it. And then, of course, equities, or risk on, risk off, as it's commonly referred to. Now, we got that stuff underway. Let's say, for example, the main theme of the market at the moment is who is cutting the most. What you then do is you only look at data that would suggest cutting. For example, would you think, in your opinion, trade balance is going to be important? No. Do you think then, I'm trying to think of a higher impact news, but it doesn't seem to be a market theme or a market driver. Sentiment data, University of Michigan consumer sentiment. Do you think that will be important? You, of course, see a little bit of reaction because it's still slightly higher impacting. But what we need to think about is it's not going to be a market-changing theme, or this data is not going to change the theme. Or, in other words, the central bank's not going to look at sentiment data and think, oh, sentiment's really poor, let me start cutting. They're going to look at the hard data. They're going to look at inflation. They're looking at growth. If we see that trend's moving lower, that's when they begin to change. But sentiment can give us a guidance in the future, but that's for another video. That's not what's known as forward-looking indicators. Forward-looking indicators is stuff like PMI data, where it gives us a guidance of what could happen in the future, but not necessarily what will happen. You have to use that with a pinch of salt. But I can make a video on that if people want that, if they want me to, of course, make it. But trade balance is not going to be important. Credit card spending, not going to be important. CPI will be important. PPI, obviously not as impactful as CPI, but still pretty important. HPI, probably not. Annual budget release, maybe not. Unless it's something significant, such as like an autumn budget from the UK. When the government then needs to talk about fiscal, then that's obviously important because that can impact growth, then inflation, then policy. Unemployment claims can be important, but overall, it's like unemployment claims for the US has largely stayed in the band of 250 to 210 anyway, so generally doesn't move markets. Existing home sales, no, it will not be important. Speakers is, of course, important. Retail sales, is important, but less of importance. Can you see how we've crunched down the data to now all we need to think about is inflation? All we need to be thinking about is growth data. All we now need to be thinking about is employment data. And that's pretty much it in a normal market environment when it's following rates and central bank rhetoric. Eventually, central bank rhetoric will get boring. Then they'll change their theme to another idea. Obviously, at that point, you'd have a very good knowledge on fundamentals, and you'll now know what to focus on at that time. But at least since 2021, late 2021, early 2022, this has been the main theme of the driver. Obviously, you have little things in the way, like wars, that then drives the commodities and risk on, risk off pillar. But if there were nothing like that, then you would mainly be following the rates pillar. So how do we apply technicals now? Remember, this video is for those who have a better idea. But like I said, you have to have a good guidance first. So for example, let me just go on a brand new chart. Let me just go on to my other avenue just over here. Let me just delete this. And what I'm going to do is just draw out an idea. So for example, if we know the data, let's say UK data is decent, growth is steady, inflation is sticky. Sticky means it just does, it's not coming down quick enough. Sticky. Central bank is hawkish, and sentiment, risk sentiment is decent. Commodities is kind of stable, but commodities doesn't really affect GBP anyway. So in that environment, you'd probably rather be long GBP. That is like, what you need to think is long UK. So that would be GBP longs XXX. But then obviously you have to do the other side of the coin as well. Exact same framework. Because the theme of the market bleeds through everybody. You have sub-themes like, I don't know, fiscal or government. They tend to be slightly shorter time. But overall, if you want to be long GBP, then for example, let's look at, I don't know, Euro or EU. Let's say growth is okay. So it doesn't have to be all of the data, right? Spelling mistake there. All of the data doesn't have to be so terrible to be short a currency. You can have growth is okay in the euro, but inflation is moving lower. Central bank is slightly dovish. That's an environment where you would be absolutely short Euro GBP. You see what I mean? Like, you don't have to have terrible growth data and terrible inflation data. You could have okay growth data, like GDP is steady, or you can have employment data is holding relatively okay. Like, we don't need to go negative numbers and GDP to slump to negative quarters and create recessions. Like, you can have decent, okay growth data. But what you need to be doing is, in your opinion, because at the end of the day, this is your opinion, right? There's much more things to talk about. Like, you can look at commitment data, commitment of traders, or CFTC data. Some people like to refer it to. You can look at rate differentials. You can look at a multitude of different things, but I'm just working with the basics here. I can do that with other videos if people are wanting me to do that, but that'll be much down the line because that's really complicated stuff. But this is like really basic stuff of what we need to be thinking about. You'd be Euro GBP shorts, because all you're doing is you're doing that versus that. So you know UK is, you want to be long, slightly dovish. Let's say you want to be short euro. So if you're trading Euro GBP, you'd rather be just selling Euro GBP. What does that then entail? Well, what that then entails is, let's say we've done this, and now we're up this. Do you now need to want to be doing demand candles for Euro GBP? No, you do not want to be doing that. What you want to be doing is looking at supply zones. So let's say we come into a supply zone here. Does technical start to reverse? No, if it doesn't, then you think, okay, where is the next supply zone? Here. Let's say we reverse from there. I have made a video on my technicals, by the way, so you can watch that. This is my personal technicals. Everyone's slightly different. But what you'll then do is, let me just do something like this, where we do that, and we come into sort of there. That's supply zone. Perfect. Supply zone there. And then I kind of extended it, but let's say that's in the zone. What I would then do, if you want a bit more on so what I would rather do when it hits a zone, please watch that video. It's called How to Apply Technicals, or the only technical video you would need to use. I think that's the word for it. I've done that like last year. But what I then do is wait for some breaker structure. So let's say there was lower time frame here. We create the high there. High. Remember, high is only a high. Or a higher low, sorry, is only a higher low if there was a high above it. So if you close above it, that's high. We then break. I will then look for a supply zone, and then I would sell it into a higher time frame zone. Because I know fundamentally it makes, like here, we may not have seen breaker structures. We might have done that, and it still would have trended. I wouldn't sell if it hits a zone. I would wait for some sort of technical reversal to occur. Then I start to get in. I'll then do, okay, cool. So I'll then zoom out. And then let's say we've come from the lows. Sorry, my drawing's terrible. I'll then think, okay, where was the last high low? Because when you sell, you aim for higher lows. And when you buy, you aim for higher highs. So what I'll then do is think, okay, that low would be my TP1 or target one. What I would then do is as it gets towards that region, let's say we're here, we're not just into that region yet, but we're close to it. I will still follow this structure and think, does it still make sense to short Euro GBP? If it doesn't, then I will exit. If it does, I'll then either take out a bit of profit or partials, or just still continue to hold the zone and sort of trail the stop loss. And then think, okay, we're at this zone. The next target is going to be down here, etc. Look at the sort of framework you worked with. All you then do is every week you just follow the data and think, okay, data's still pretty good for the UK. Euro data's starting to slow down or still slowing down. I still want to remain short Euro GBP. That's all you're doing when you're looking at technicals and fundamentals, is you get a guidance first on what has been the driver. So what is the theme, basically? If the theme is all about rates or all about what the central bank is doing, just follow the data that would suggest what the central bank is doing. Then all you do is every week look through the calendar and think, is the data in that economy still pretty good? If it is, perfect. You still want to be short that currency pair. Does that make sense? So remember, it's complicated and nobody said it's easy. I was absolutely confounded, if that's even a word, when I started out. Then as you get into it, like technicals, you know, when you start to learn technicals, are really tricky and really, really complicated. But the more you do it, the easier it became. It's the same thing with fundamentals. It's just that learning curve is a little bit more steeper. But if you're interested in trading, you would want to know as much as you want with trading, right? That's just my personal opinion. If I am interested in cars and I am sort of in a business of a car, then I will absolutely want to know as much as I can about the car, because then it separates me from the rest of the crowd. That's how I see it anyway. That's just my way of looking at it. So overall, that's what we need to be doing. There's a lot more things to think about here, like positioning. If positioning is too stretched on a currency pair, like let's say CFTC data is up here is extreme longs on the pound, then you'd rather still not buy the pound, or you can take it out and sort of not take out your profit and try and maximize your gains. That's not just things to think about in the future, but I can make a video on that if it's necessary. Rate differentials, like if the currency pair is, for example, up here, but rates 2-year yields, 2-year bunds versus gilt 2 years suggest Euro GBP should be down here, then you use that as like a magnet or a target and think, okay, that would suggest year of GBP should be at X based on rate differentials. But that's like that's like a big video in on itself, and that is needed for like a lot of, like, you need to have a really good knowledge on inflation and interest rates and policy. But that's what I was saying is, as we work through the series, you should hopefully have a good idea. So for now, what I would do is watch our playlist video, because we go through all of the basic stuff you need to know, then try and start to apply that. If you have any questions, please let me know in my Instagram at it's Mark Fraser. If there are any other suggestions on videos, please let me know, because I don't know what videos people want. So if you let me know, I will get onto them as soon as possible. But apart from that, everybody, I appreciate you all for being here. And this is the start of our sort of video series. But yeah, hopefully there's been some sort of insights. I know I've gone through a lot, but hopefully this video is more for those who have a little bit of a good guidance on fundamentals. But if not, please watch our playlist series, and I will see you in the next video. Take care, everybody.